Hi everyone, Martin Bamford here. Has the Turkish president lost his mind? Economics 101 tells us that when price inflation is rising, governments and central banks should raise interest rates to bring it back under control. That's not happening here in the UK at the moment, of course, with the Bank of England instead dithering and delaying, allowing this surging inflation story to play out. But in Turkey, President Erdogan has gone in a slightly different direction, a direction that some would call absolutely bonkers. Rather than hiking rates to deal with persistently high price inflation, Turkey has cut them again this week, trashing its currency in the process. The Turkish lira fell by around 6% in response to this latest interest rate cut, a new record low, with fears that Erdogan's fixation on low costs of borrowing will further fuel rampant inflation in the country. Turkey's central bank cut the one-week repo rate 1 percentage point to 15%, the third such reduction in interest rates since the start of September, when it stood at 19%. According to the central bank, many factors behind rising price inflation were beyond monetary policy's control. It will apparently consider ending the cycle of rate cuts next month. Okay, I'll accept that many of the factors driving higher prices right now are not going to be particularly affected by interest rates in a particular country. I've already made that argument for why the Bank of England might leave rates on hold at their historic low at 0.1% here in the UK. After all, what is the point in pushing up the cost of borrowing and inflicting economic harm, financial harm on your economy, if it will have more or less zero impact on things like wholesale gas prices and the global supply chain crisis? However, financial markets do not appear to agree with that assessment, which is why the Turkish lira fell by 6% to this record low, albeit easing up now slightly by the end of trade on Thursday. But it is still bad news for the lira, which is down by almost a third so far in 2021, making this currency crisis that Turkey is going through at the moment almost as bad as the one they experienced back in 2018. The fear here is that lower interest rates will fuel an inflation spiral. Keep in mind that price inflation in Turkey is significantly worse than it is here in the UK, or even in the US, where President Joe Biden is doing his level best to make it worse through massive stimulus spending. In Turkey, consumer prices rose by almost 20% in the year to October. Now, Paul McNamara, who's an investment director specialising in emerging markets at GAM, said it's mystifying why they would do this, and also said the only driver for a weak lira is the policy outlook. Now, we know that Turkey's central bank has found itself under pressure from this authoritarian president, Erdogan, to loosen its stance on monetary policy despite these very high rates of price inflation. But by weakening the Turkish lira, that's likely to make price inflation even worse. A weaker currency means a higher cost for imported goods, so it's likely to lead to a vicious cycle for price inflation. We know that Erdogan believes, contrary to all mainstream economic doctrine, that high interest rates cause inflation. They don't. Earlier this week, he renewed his previous pledge to release Turkey from the scourge of high interest rates, saying, "I'm sorry to our friends from the ruling party who defend high interest, but I cannot and will not walk the same path as them." Announcing this latest contrarian interest rate cut, Turkey's central bank blamed higher prices on the transitory effects of supply-side factors. Those supply-side factors include high global food and energy prices, both expected to remain high into the first half of 2022. It also said that many advanced economies were continuing to pursue monetary policy stimulus, partially because they expect this bout of global inflation would be transitory, not sticking around for the medium to long term. On the plus side then, when looking at emerging market economies, Turkey is an outlier in terms of cutting interest rates. South Africa and Hungary have both this week announced rate hikes. Even in developed economies, in the US in particular, the Federal Reserve has declared its intention to reduce stimulus measures, something that to date has indirectly hurt emerging market economies who needed to increase interest rates to attract inward investment. What's happening in Turkey this week appears to be what happens when politicians have too much say, too much influence over economic policy. It's why it's broadly positive that the Bank of England has independence in setting monetary policy here in the UK, something it's had in place since 1998. And in the US, while the chair of the Federal Reserve is based on a nomination made by the president, something we're waited for bated breath with as I record this video, in fact, it does for the most part operate independently from the US government. So what do you make of of Turkey's decision to cut interest rates at a time when other nations are putting them up, or at least leaning towards tighter monetary policy? Do let me know in the comments. Thank you for watching this video. Until next time, I'm Martin Bamford, and remember, when it comes to your money, the more you know, the faster it can grow.